Hello everyone, welcome back to the course Strategic Management Accounting. Topic 6, Quality Costing. We discussed in the previous lectures that there are three interrelated domains of strategic actions in which strategies can be enabled and enacted differently. The market or the competitive terrain, the organizational hierarchy, and the point of production. We had two lectures to talk about the manner in which strategies are enabled and enacted in the market. Generic strategies and strategic pricing. Then we also had two lectures to talk about how strategies are enacted and enabled in the form of management controls and performance management within the organizational hierarchy. Now we are moving to the third domain of enabling and enacting strategies, the point of production. When it comes to the point of production, there are three strategic imperatives that we have to deal with: quality, cost, and flexibility. So this is the first lecture about how we enable and enact strategies at the point of production. And this lecture specifically deals with quality. And our primary attention will be the costing dynamics of quality. How paradigmatic understandings or different paradigmatic understandings of quality implicate on the behavior of quality cost. So we try to understand in a traditional quality cost paradigm how we assume, how we conceptualize the manner in which quality cost behave. And similarly, we would talk about how we can conceptualize and understand the quality cost behavior in a zero defect quality paradigm. And then we also talk about how we can understand and conceptualize the behavior of quality in a continuous improvement quality paradigm. Then finally, we will have a discussion on how should we classify and analyze quality associated cost in order to manage quality strategically. So that is what we are going to discuss in this particular lecture. Because this topic is about quality costing, we need to first start with some definitions of quality. Especially when it comes to the quality of a product, there are so many different ways that we can define quality. At least I can think about 6 different approaches to define quality. The first approach is the product-based approach. According to this approach, the quality is defined on the basis of a specific attribute or a set of attributes of a product features. So, for example, you might be thinking about the quality of a product on the basis of its durability, its strength, its taste, and any other product features. So, if you think about the quality of a product on the basis of such attributes, certain features that constitute the product, then it is the product-based approach to define quality. Then the second one is manufacturing-based approach. According to this approach, we would define the quality as the conformation to the design specifications. So at the point of designing the product engineers or product designers or production managers would have a specific set of product specification, technical specifications. For example, diameter, width, or any other features of the product, specified, spelled out as a specific set of technical specifications. And then during the manufacturing process or after the manufacture of a given product, you would take a sample and assess that particular sample's quality by checking whether that particular sample of the output conform with the predetermined technical specifications of the product. That's how the quality of a product is judged, evaluated by the manufacturing engineers, production managers, as the confirmation of the product or manufactured product to a set of pre-decided product specifications. And then thirdly, we have value-based approach. This is looking at the product from the customer's perspective, from the customer's value perspective. So by owning or consuming a particular product, a customer would get a package of benefit, a package of value. And the customer would not consider about that particular package of benefit, value or features on their own. The customer would have a relative assessment of that features, benefit on the basis of the price that the customer has to pay. So that is the value-based approach, value for money. The value package that the customer gain by owning or consuming the product divided by the price that the consumer has to pay. It is, in a sense, the relative marginal utility. The utility divided by the price of the product. And then the fourth approach is what we call user-based approach. So here our attention is the specific customer needs for which the particular product is bought or consumed. So by owning or using a particular product, the customers are expecting to meet a particular demand, a particular need, a particular want. So in this sense, the user-based approach defines the quality of a product as the capacity that particular product has to satisfy or exceed the customer needs. And then next one, we have transcendental approach. So according to this transcendental approach, the quality is defined both by the particular features, attributes, capacities of the product to satisfy the customers. That means all the things that we discussed so far, the things that we discussed under product-based approach, manufacturing-based approach, value-based approach, as well as user-based approach. All those things would determine quality on the one hand. But on the other hand, the quality is equally determined by the customer's mindset, customer's value system, customer's belief systems, and so on. So there is the object, the product, that would determine, that would influence the customer perception about the quality. But on the other hand, there is the customer's mind as well. So in this transcendental approach, quality is something beyond definition. It is neither the matter on its own, nor the mind on its own, but a kind of a third entity, a third outcome created by the interaction between these two. So the quality comes out because of the matter, the product, the object, as well as the mind. But it is neither the mind nor the matter on their own. It is something else created by the interaction between these two things, the object, the product, and the customer's value system, belief systems, or in a broader sense, customer's mind. So that is what we call transcendental approach. Then finally, we have social constructivist approach. So according to this approach, the quality is something socially constructed by various means. For example, by advertising, by various statements given by influenceable, powerful epistemic agents. For example, in the case of toothpaste, a dentist appear in the television advertisements and talk about the toothpaste. Or in certain cases, some expert will talk about the product and various public opinions and so on. So the quality is something socially constructed. So that is the social constructivist approach to define quality. So these are the 6 different approaches according to which we can define quality. However, when we think about these 6 different approaches, we understand that quality can be defined in so many different ways. So having such a variety of definitions is wonderful in a sense, but would not be helpful when we are trying to think about quality cost. So we need some sort of an operational definition on the basis of which we can define and identify the behavior, clarify the behavior of quality cost. So for that purpose, we have an operational definition of quality, which we define as quality is 1 minus defective rate. So that is a specific equation, an operational definition. And this operational definition is very important to identify and understand how the quality cost behave. So in this definition, the defective rate is the probability that our manufacturing system may produce a defective product. So if we have a defective rate of, say for example, 5%, that means out of 100 units that we produce in our production system, there's a probability that 5 may be defective. If we have, for example, a 1% defective rate, that means out of 100, we would have 1 unit defective. This is a probability. Some companies are now talking about 6 sigma quality level. That means they would only have a 1 defect product probably out of 1 million units that they produce. So that is what they call 6 sigma quality level. So this is the defective rate, the probability of the system to produce a defective product. So therefore the quality is 1 minus this defective rate. So that is, in overall, quality means the effective rate, the probability of producing good, useful products. Not bad product, but good products. Not defective products, but effective products. So that is what we mean by quality in an operational sense. So to repeat it, to emphasize it, in order to have a better understanding of the manner in which quality cost would behave, we need to have an operational definition of quality. And we have this operational definition as 1 minus defective rate, where defective rate is the rate at which, or the probability at which, our production system, the company's production system, may produce a defective product. And it should be emphasized here, this definition of quality, this operational definition of quality is not a definition of product quality. So this is nothing about the quality of a given product as we discussed in the previous 6 different approaches. This is the quality of the production system, not the product, but the production system. How good our production system is. How good our production system in producing good products. Or inversely, how bad our production system in producing bad product. So if we have a 10% defective rate, that means 90% quality rate, that means out of 100 units we are producing, 90% will be good. There is only 10 customers would experience a defective product, but that is a huge proportion, 10%. But on the other hand, 1% is much better. Only one customer probably out of 100 would experience a defective product. So if we have a 6 sigma quality level, only 1 out of 1 million customers would experience a defective product. So this definition defines the capacity of the production system to produce good products. On the basis of the operational definition of quality that we just discussed, we can identify 4 categories of quality cost: internal failure cost, external failure cost, detection or appraisal cost, and fourthly, prevention cost. All these cost categories or cost elements are incurred to make sure that our production system can produce good products. In a broader sense, these cost elements are associated with the probability of the production system to produce a good product, or inversely, the probability of producing a bad product. Of these 4 categories of cost, the first 2 categories are associated with producing a bad product. Those are the cost of being bad. Those are the cost to be incurred when we produce a defective product. So these are the cost of non-conformity or non-compliance to the quality standard. So in the cases where we are not in compliance with the quality standard, so the internal failure cost and the external failure cost occurs. Internal failure cost is the cost associated with a situation where we have produced a defective product and that defective product is being identified, recognized internally before it moves to the customer. So our internal quality assurance, quality checking has identified this defective product. So all the cost associated with this defective product, which is internally recognized, is what we call internal failure cost. This can include, for example, scrap, the cost of scrapping it, and then cost of rework, and all the labor, material and overhead cost so far incurred on that product, if that product is totally irrecoverable. And not only that, so there may be various other costs to be incurred. For example, disposing the bad product, resetting the machines, and checking all the systems, process and machines, raw materials and everything to ascertain why this particular bad product is being produced. So once there is a particular bad product detected internally, there's a lots of cost associated with that particular defective product. And all this cost is identified as internal failure cost. Then, in contrast, external failure cost occurs when we have produced a defective product and that defective product has gone to the customer. And it is the customer who identified, who experienced the defect of the product. So the customer complains. So the product is gone to the customer. Now it is an external failure. Then all the cost associated with that external failure is called external failure cost. which include, for example, warranties, guarantees, returns, replacements, and so on, as well as non-quantifiable damages to the reputation, goodwill, the brand name, and so on. And there may be, for example, various bad reviews appearing in online platforms. So these all constitute the external failure cost. And both the internal failure cost as well as the external failure cost are associated with the probability of the system producing a defective or a bad product. So it is the cost of being bad, non-compliant, non-conformance, which can be internally or externally. And then the next two categories, appraisal cost and the prevention cost, are the costs associated with being good. Those are the costs associated with the production system is good. So the probability of producing a good product is high and the probability of producing a bad product is very low. So in order to keep the probability of producing a bad product or a defective product low, we have to incur various sort of cost appraisals, cost assurance. So we have to have various kind of checkings. We have to make sure that we check our raw materials. We have to make sure that we check our machines regularly, check our process regularly, maintain our process machines regularly. And we have to have certain quality inspections at different points in our manufacturing system. And that's what we call detection and appraisal cost. And when we have detection and appraisal activities, more and more appraisal and detection activities, the probability of producing a defective product will be low, but we have to incur more cost. And similarly, the prevention cost is sort of cost that we incur in order to make sure that at the design stage, at the very conceptual level, the system would not produce a bad product. So it might include, for example, research and development expenditures and research or product design expenditures, process design expenditures, and maintaining a proper supply chain networks and making sure that we are only getting quality raw material, quality components from reputed, manageable suppliers. So that sort of cost that we incur to prevent the production of defective products is called prevention cost. So these four cost elements are the four key categories into which we classify various costs associated with, various expenses associated with quality management. And one way or the other, these costs are associated with the probability of the production system to manufacture either a bad product or a good product. So when we manufacture defective products, then we have to incur internal failure cost and external failure cost. On the other hand, when we manufacture good products, effective products, we have to incur detection or appraisal cost and the prevention cost. So you would understand there is some sort of inverse connection between these four categories of cost elements. The first two categories would be higher when we incur lower on the second two categories. The failure cost will be higher if we incur low on compliance cost. And if we have more investment on compliance, if we have more investment on detection and appraisal and prevention, then the probability of having internal and external failures will be low. So the first two categories and the second two categories would have a kind of inverse connection between them, which we will discuss further when we are talking about quality cost curves under different quality paradigms. With that understanding of the elements of quality cost, we can now talk about the management of quality cost. When it comes to the quality cost management, we have to determine the level of quality at which the total quality cost is minimized. So that is the fundamental conceptual parameter according to which we would manage quality cost, deciding the level of quality or the optimum level of quality at which the total quality cost is minimized. That means we have to think about the relationship between level of quality on the one hand and the quality cost on the other hand. We have two variables here. The first variable is the level of quality, explanatory variable, the variable that we are going to depict on the x-axis. And then second variable is the quality cost, the variable that we are going to depict on the y-axis. According to our operational definition of quality, which is quality is 1 minus defective rate. Quality is the probability with which our manufacturing system can produce effective good products. Therefore, the level of quality is measured in between 0 and 1. So 0 is a situation where we have a total failure, an utter failure. Everything that our manufacturing system produces is defective. So that is that end of the quality level. 0 quality level. 100% defective rate. That means everything that we manufacture is going to be defective. And then in this extreme of the spectrum, we have the perfect quality level. A 0 defect rate. That means everything that we are going to manufacture in our production system is going to be good, effective products. So the actual quality level can be in between this 0 and 1, or perhaps even on 1 if we are managed to reach the perfect quality level. Then we have to think about how the quality cost would behave according to the level of quality. What would happen to internal and external failure cost? What would happen to appraisal and prevention cost when our level of quality changes? That is the understanding, that is the conceptualization we need to have. How the quality cost elements would behave according to the level of quality. And that understanding, that conceptualization depends on the specific quality paradigm according to which we would think about quality and the cost. So this is an important point to emphasize. The manner in which we conceptualize and we understand the connection between level of quality and the quality cost depends on the specific quality paradigm according to which we think about quality and the cost. There are 3 quality paradigms that we need to talk about. The first one is the traditional quality paradigm. And the second one is zero defect quality paradigm. And the third one is continuous improvement quality paradigm. Our understanding and our conception of the connection between the level of quality and the quality cost depends on which paradigm we would follow. Now, let's start with the traditional quality paradigm. And then let's think about the connection between the level of quality and the cost of failure, cost of non-conformance or non-compliance, which is basically the internal failure cost and the external failure cost. Now let's think. If our production system is an utter failure, a total failure, where we have a zero quality level, 100% defective rate, everything we manufacture would be defective. That means our internal failure cost and the external failure cost would be infinite. We would have an infinite amount of cost related to internal failures and external failures. So that is that end of the spectrum. And then when we improve our quality level, when we reduce our defective rate gradually, internal failures and external failures would become lower. The amount of cost that we have to incur on internal failures and external failures would become lower. And then finally, when we reach the perfect quality level, zero defect rate, where we would not have any defects either internally or externally, our internal failure cost and external failure cost both together would become zero. So that is what this curve, the internal failure cost and external failure cost curve, illustrate here. A negative inverse connection between the level of quality and the failure cost. The lower the level of quality, higher the failure cost. The higher the level of quality, lower the failure cost. So, there is a negative relationship between level of quality and the cost of failure, both internal and external failure cost. Then, if we think about appraisal cost and the prevention cost, that means the cost of conformance, cost of compliant, and cost of being good. There need to be a positive relationship. If we do not spend any money on prevention activities and appraisal activities, then there would be a higher amount of defects. So the quality level will be very, very low. So when we have a low quality level, we possibly have very low appraisal and prevention cost. And our quality system is not good enough. Our quality system is bad because we are not spending enough money on appraisal and prevention activities. And then, when we increase our expenditure on appraisal and prevention, our level of quality will increase. And ultimately, when we reach the perfect quality level, zero defect quality level, we would have invested a considerable amount of money on appraisal and prevention cost. So as this diagram illustrates, therefore there is a positive connection between the level of quality and appraisal and prevention cost, or in other words, cost of conformance. So that is the relationship between level of quality and cost of quality. And then the total quality cost is the sum total of all these cost elements. The total quality cost would be the internal failure cost plus external failure cost plus appraisal cost plus prevention cost. When you put them all together, that is what we call the total quality cost. So that basically means a vertical summation of the two cost curves in this diagram. So we have the failure cost and we have the conformance cost. When we combine them together vertically, we have a U-shape total quality cost. And that U-shaped cost curve is the total quality cost. And in that particular curve, you have a minimum point. So the optimum quality level is the point at which the total quality cost will become minimized. So that is the point at which you optimize your quality level. So this is the traditional quality paradigm where you would locate, you identify a particular level of quality at which the total quality is minimized, and you call it the optimum quality level. Now, according to this diagram, you would realize that there is a particular range of quality, a better quality, higher level of quality than the optimum level. However, that higher level of quality, better level of quality, is considered to be non-optimal because it is too costly. It is the range of quality, even though it is higher, better than the optimum level of quality, the managers would not go for it because it is too costly. So the point here is, in this traditional quality management paradigm, the optimality is decided based upon the cost. So any point beyond the minimum total quality cost would be considered not viable, not advisable, not acceptable. Why? Too costly. There's a classic, famous, notoriously famous case about this kind of decision making. That is the Ford Pinto case. It's a very famous, notoriously famous case. There are lots of material on this particular case on the web. You can search and find it. And it would be a very good, interesting reading for you. So the Ford Pinto case happened in early 1970s, where the majority of the companies were thinking about quality management in terms of the traditional paradigm of quality management. Now, Ford Motor Company introduced a new model to the market, Ford Pinto model, in early 1970s. At the point of introducing this product to the market, they knew that there was a defect in the fuel tank. By design, there is a defect in the fuel tank. The product designers, production engineers, as well as top management knew that there is a problem in the fuel tank. The defect is such that if this particular model of car is hit by another behind at an average speed of 30 miles per hour, or sometimes even 28 miles per hour, the fuel tank will rupture and would empty all the content of the fuel tank in less than a minute, resulting in a quick fire, leaving no time for the passengers to get out of the car. So that is the seriousness of the defect. And the company management knew that this defect is there in the fuel tank. But still, they launched the car. They let the car go to the customers. And then they could have recalled the car and correct the defect. As normally nowadays automobile companies do. When they understand that there is a defect in a car, they would recall all the cars and do the repairs free of charge. But at that time in 1970s, they didn't do that. Why? Now notoriously famous, they did a cost-benefit analysis. They carried out a particular cost-benefit analysis as illustrated here. So this is the summary of the cost-benefit analysis that Ford Motor Company did at that time. According to this cost-benefit analysis, they estimated that out of 11 million cars and out of 1.5 million light trucks that they sold, there is a possibility of 180 burn deaths and 180 serious burn injuries and 2,100 burn vehicle repairs or damages. So that is their estimation. And then they had very problematic, very questionable, rather unethical estimation on the value of life and injuries. This later on became a huge public outcry. So they estimated they may have to pay $200,000 per every death. That is the estimated damage payment for death. And then estimated damage payment for injuries, 67,000 per injury. And then they also estimated that the repair cost for the damaged vehicle would be 700 per vehicle. And therefore, the total benefit that the company can gain if they recall all these cars and carried out the necessary corrections, necessary repairs, then the total cost would have been, that is the total benefit that they could have get by recalling the cars is estimated to be 49.5 million. That was the estimation they did. And then they also carried out a cost estimation. How much they have to spend to recall the cars and correct or repair this defect. So the estimation is £11 per car multiplied by the number of cars involved in this recall. Ultimately, they estimated the total cost of recall would be 137 million. And the cost outweigh the benefit according to their assessment. And in addition, they also thought that recalling the cars would be a highly negative public advertisement. There would be a negative impact on the company image. And considering this cost-benefit analysis and the possible negative impact on the company image, they decided not to recall the cars. Let it go. And later on, some people met with various accidents and some people died. And in one case against the motor company, the jury decided that the company should pay punitive damages of 125 million, which is estimated to be a little bit bigger than the total profit that the company earned by selling this particular car. So that is the jury decision later on imposed upon the company as the fine, which later on anyway reduced considerably by the Supreme Court or the Appeal Court judges. So this Ford Pinto case provides a good example of the manner in which the quality level is decided in the traditional paradigm of quality management. A certain level of quality would be considered as not desirable, not to be considered, because it is too costly. So there is a particular range of quality, even though that range of quality is higher than the optimum level of quality, that range of quality would not be considered under cost consideration. The cost is the ultimate decision criteria. So you would decide your level of quality on the basis of cost. So that is the traditional paradigm of quality. So in brief, we understand a particular relationship between the level of quality and the cost. The failure cost, internal and external failure cost, should be inversely negatively connected to the level of quality. Whereas the appraisal and prevention cost should be positively related to the level of quality. So accordingly, the total quality curve would be a U-shaped curve with a minimum point. And that minimum point would be considered as the optimum quality level. So that is the point at which the company wants to be. Anything better than that is considered to be too costly. So even though that level of quality is better and good, that will not be considered under the cost considerations. Ford Pinto case provide a classic example of this type of decision making. Then, in response to such litigations and various public discourses, and also the popularization of business ethics and social responsibility discourses, and also the signification of Japanese management style in the West, there emerged an alternative paradigm of thinking about quality and quality cost. That is the zero defect quality paradigm. Now, in this zero defect quality paradigm, we still think about the relationship between the level of quality and the failure cost, internal and external failure cost, in the same manner. There would be inverse or a negative relationship between the level of quality and the internal and external failure cost. So ultimately, when we reach the perfect quality level, zero defect quality level, the internal and external failure cost would become zero. So that is the connection between the level of quality and the quality cost of failure. So there is no difference in that curve. The same negatively related cost curve still applies. However, when it comes to the appraisal and prevention cost, there is a small but very significant conceptual change. That is, yes, initially, in the initial stages of quality improvement, there would be a positive connection between the level of quality and the appraisal and prevention cost. Yes, to increase or to enhance the level of quality, you would have to spend more and more on appraisal and prevention cost. So still, the positive connection between level of quality and the appraisal cost and the prevention cost is valid. However, that cost would reach its maximum when the level of quality reaches 1. That means when our system of production reaches the perfect quality level, when our system of production reaches a level where we do not produce any defects, then beyond that point, there is no need of any more expenditure, any more investment on appraisal and prevention because we have reached the best. So, therefore, the appraisal and prevention cost increase gradually but reach its best, its maximum at the point of zero defect. So, that is the end. So, at that point, the quality curve stops. And therefore, the total quality, which is the sum total of internal and external failures and the appraisal and prevention cost, would be minimized at the point where we reach the zero defect. So, therefore, according to the zero defect quality paradigm, the optimum level of quality should be always the zero defect quality level. So the companies should try their best to reach the zero defect quality level. That is because that is the point at which ultimately the total cost associated with managing quality will be minimized. So there is no any other point. It is only the zero defect, the perfect quality level that is desirable. So that's how the zero defect paradigm modified the traditional paradigm of quality management. A slight modification, but significant modification on our assumption about the way the appraisal and prevention cost would behave. The appraisal and prevention cost would reach its maximum when zero defect quality is achieved. Therefore, the total quality would be minimized at that particular level. Now, even in this zero defect quality paradigm, we have to keep in mind, I have to emphasize that the ultimate criteria to determine the level of quality that we should be in is the cost. Still, even in this quality paradigm, the criteria upon which we decide our level of quality is the cost, the minimum cost point. But incidentally, under the new conceptualization, under the new theorization, under the new set of assumptions, we understand that we can reach the minimum quality cost where the defect rate becomes zero. So, trying to achieve the zero defect is possible and it should be the ideal. So, that is what we call zero defect quality paradigm. Then our third quality paradigm, which is a further advancement of zero defect quality paradigm, is the continuous improvement quality paradigm. Now, the continuous improvement quality paradigm holds the same assumptions as in the case of zero defect quality paradigm. It assumes that there is a negative connection between the level of quality and the internal and external failure cost. So, which was the case even in the traditional quality paradigm, zero defect quality paradigm, and now in the continuous improvement quality paradigm. So, there is no difference. And then, when it comes to the appraisal and prevention cost, as in the case of zero defect quality paradigm, the continuous improvement quality paradigm also assumes that the appraisal and prevention cost will become or will reach its maximum when the zero defect is achieved. So in that sense, the point at which the total cost can be minimized is zero defect. So it is same as the zero defect quality paradigm's understanding. However, the continuous improvement quality gurus argue that they believe that through various kind of further improvement, continuous improvement, so-called kaizen, through various kind of techniques such as quality circles and other various techniques we collaboratively call total quality management techniques, the company can continuously reduce the cost curve. The appraisal and prevention cost can continuously be reduced, shifted down. So through various innovations, through various redesignings, continuous improvement, the quality cost can be shifted down. And that is the possibility. By doing that, they can ultimately, in the very, very long run, should be able to bring the total quality management cost to zero. That means theoretically or conceptually, ideally, it is possible. And therefore, pragmatically, it should be possible, according to continuous improvement quality gurus. Ultimately, to reach a level of quality, a zero defect quality, but without incurring any extra additional quality management cost. How do you do that? So they believe you can do that by having proper process designs, proper production systems, manufacturing systems, by incorporating and inbuilding all quality activities into the very production process. So therefore, there wouldn't be any extra additional quality management activities. When the quality checks are incorporated into the process itself, the manufacturing process itself, then there is no extra quality managers, quality inspectors checking the quality, because the quality is quality is checked automatically by the manufacturing system itself. And all the quality activities to be carried out separately by the quality managers, quality assurance people, and various other peoples responsible for quality management should be now carried out by the very core employees. Not as a separate quality management activity, but integrated so smoothly into the very activities they carry out in the name of production, distribution, and so on. So once you reach that particular point, then everything and everyone will be thinking about quality. The quality will become everybody's job. Quality is everywhere. Quality is everything. So when that particular stage is achieved, you have achieved a total quality management. Everything needs quality, everyone needs quality, and quality is incorporated into everything we do. That is a total quality management conception. So under that conception, one day a company should be able to reach a level of quality, zero defect quality, perfect quality, but without any extra quality management cost. So in a broader sense, continuous quality management gurus and that paradigm of quality management believes that through the continuous improvement to the product, processes, activities, and so on, the quality cost should be ultimately reduced to its bare minimum, zero, and achieve the perfect zero defect quality. So that's what we mean by continuous improvement quality paradigm. Key elements of a quality costing system. That is the last theme that we have to discuss in this topic. A quality costing system is the system through which we capture, record, classify, analyze, and report all the costs associated with various activities, events, and transactions of managing quality. As in the case of any other accounting system, a quality costing system should also have a transaction processing element. That is the first element of a quality costing system. A set of techniques, tools, and procedures through which we would recognize, identify, and capture events, transactions, and activities associated with quality management. And in the process of that capturing, we would estimate and we would identify the cost associated with those events, transactions, and activities. So that is the first element. The procedures, techniques, and tools through which we would capture the relevant event, transactions, and activities. And then, once those event, transaction, and activities are captured into the system with the relevant monetary values, quantitative values, or numbers, then we need to classify them to the relevant cost categories, to relevant cost accounts. For that purpose, we need to have a system of coding. And that is the second element of a quality cost or quality costing system. A system of coding according to which we would classify various cost elements, events, transactions, and activities into the major cost categories. And those major cost categories would include, as we discussed already, internal failure cost, external failure cost, appraisal cost, and the prevention cost. And we should have, therefore, a system of coding through which all the cost documented, all the cost we capture through our systems are automatically classified into these four major cost categories. And then, thirdly, we would have to analyze. On the basis of this classificator schema, on the basis of this coding schema, we have to analyze our data. So analysis basically means preparing a cost statement. A cost statement would have very well classified, well organized report, where we would report that this is the total cost associated with all the cost management activities or the quality management activities we carried out for a given accounting period. So for this particular accounting period, so this is the total cost for quality management. Then we would classify them, as we just mentioned, into the relevant themes or relevant subheadings or categories. So this is the total of internal failure cost, and this internal failure cost constitutes of these key cost items. And similarly, this is the total of external failure cost, and that external failure cost constitutes of these key cost items. And similarly, appraisal cost and the prevention cost. These are the totals, and that total is composed of these specific cost items. And then these numbers have to be analyzed and reported in a relative sense. Relative sense means very often we would report these numbers as a percentage of the total sales figure. So here is our total internal failure cost, and which is as a percentage of sales this much. And here is our external failure cost, which is as a percentage of our total sales this much. And our appraisal cost, our prevention cost, as a percentage of sales this much. When you compute, when you calculate these figures as a percentage of sales, then it is easy to compare. So it provides a better comparative base based upon which we can compare our performance, our quality management cost performance with the previous years and any other benchmark. And then when we are analyzing and reporting these cost through our cost statement, we have to have some sort of a comparison. So that comparison could be either with the previous accounting period information. So this accounting period information compared with last year or last accounting period information. Or your comparative base could be your budget or standard cost. So this is our actual amount and this is the budgeted amount, and we have a variance. So that comparison could be as a variance. Or that comparison could be against some industry benchmark, external data. So one way or the other, we need to have a comparative sense of the data we have, of the accounts we have. And then we would report them to the relevant people, to the board of directors or any other top executives or the quality managers and so on. So in collaboration with them, we would assess the relative strength and weaknesses of our quality management system and whether our quality management system is progressing or not. For example, if we want to think about whether our quality management system is progressing or not, we would compare our current year data with the previous years and then would identify what is the trajectory of cost incurrence. Now, for example, when you are comparing the current year data with the previous year, there could be 4 different scenarios. And this is very interesting and useful schema to judge how our quality management activities are progressing or not progressing. Now think in this particular manner. So when we compare this year cost of failure, that is the total of internal failure cost and external failure cost with the last year, we could have 2 possibilities. That is, the first possibility is this year total internal and external failure cost is greater than or more than or higher than the last year. So last year our internal and external failure cost was a particular amount, say for example 100,000, and this year it is 120,000. Or more usefully, as a percentage of sales, it was only 10% last year, this year it is 20%. So that tells you there are more failures. That means at the outset, our quality management has not progressed, has not improved. But on the other hand, if this year internal and external failure costs are relatively lower than the last year, then it is a better condition. So looking at the internal and external failure cost, you can think whether we are really enhancing our quality management. Is our quality management system is more productive or not? Have we been able to deal with our internal and external failure cost? Then you have to look at your cost of conformance. How much you spent, how much you invested for appraisal and prevention. So that could be again 2 types. Compared to the last year, this year the figure might be lower. Compared to the last year, this year, the figure might be bigger. Now that becomes interesting. Now, in that sense, you can have four possible scenarios. That four possible scenario is that you have spent more money, you have invested more money on appraisal and prevention compared to the last year. And as a result, you have managed to reduce your internal and external failure cost. That's a good scenario. More investment on appraisal and prevention, and as a result, your internal and external failure cost has gone down. As expected, obvious, but a good result. Then the second possibility is that you have spent more money on investment, you have invested more money on appraisal and prevention. But your internal and external failure cost has gone up. So that is a huge question mark. So you should have wasted some money. Still, even with the more and more expenditures, you are not doing the right thing. You are trying to do the right thing, but you are not doing the right thing. So you have to carefully investigate further and see what's going on here. There is something fundamental wrong here. You are investing more, you are spending more on appraisal and prevention, but still the internal and external failure cost goes up. That's really bad. And then the third possibility is that you are investing less money on appraisal and prevention. And as a result, you have high internal and external failure. Understandable, but a bad scenario. So obviously, you have to rethink about prioritizing your appraisal and prevention activities. You have to spend more money on that. Then the most favorable situation is that you have spent less money on appraisal and prevention. Your total amount of investment on appraisal and prevention has gone down, but you have also managed to reduce your internal and external failure cost. That is the most favorable situation, and which would manifest a continuous improvement. So you have been redesigning your systems, you are carefully re-engineering your system so that you have been able to spend less on appraisal and prevention while improving the quality, while managing to get a lower rate of internal failures and external failures. So that is the four possible scenarios you would identify when you compare your current year data with the previous year data. And that schema would provide you a good framework through which you can analyze and interpret and report quality cost data. Now with that, we have reached the end of this lecture. So as usual, to summarize. So we started this lecture with some definitions of quality. And we discussed 6 different approaches according to which you can define a quality of a product. However, these 6 different approaches provide wonderfully different understanding, meaning of quality, and you can appreciate the complexity of the quality. But when it comes to the management of quality cost, we need to have an operational definition. So our operational definition of quality was quality is equal to 1 minus defective rate. And that particular definition of quality does not define the quality of a product. but instead it defines the quality of the production system. How good our production system in manufacturing effective good products. So that is the probability with which our manufacturing system would produce good products, or inversely would produce defective products. Then, on the basis of that particular definition, we identified 4 categories of quality cost: internal failure cost, external failure cost, appraisal cost, prevention cost. Internal and external failure cost are taken together. The failure or non-compliance or non-conformance cost. Appraisal and prevention cost constitute the cost of being good, the cost of conformance or compliance. And these two major categories of cost, that is the failure cost and the conformance cost, are inversely related with the level of quality. The failure cost is negatively connected with the level of quality, and appraisal and prevention cost is positively related to the level of quality. Then we talk about 3 paradigms of quality management: traditional quality management, zero defect quality management, and continuous improvement paradigm of quality management. And in all these quality paradigms, the ultimate criterion according to which we determine the optimal quality level is the cost. So we have to determine the level at which the total quality cost is minimized. According to the traditional quality paradigm, according to the assumption of the traditional quality paradigm, the total quality cost would be minimized not at the zero defect rate, but lower than that. That means the traditional quality paradigm would have a range of quality which is higher than, better, or greater than the optimum quality level, but would not be considered as optimum. It is non-optimum because too costly. That kind of thinking is manifested by, exemplified by Ford Pinto case. And then later on, this traditional quality management framework is revised by the zero defect quality management. And in this particular framework, we have a slightly modified assumption about the appraisal and prevention cost. And that modified assumption leads us to believe that the optimum level of quality is the zero defect. That is because that is the point at which ultimately the total quality cost can be minimized. And the continuous quality management paradigm holds the same assumptions, same conclusion, but believes that particular quality or zero defect quality level can be achieved with a much lower cost through continuous improvement. So through continuous improvement, that cost can be further reduced and reduced and reduced, and ultimately, eventually, theoretically, it can bring down to zero. So the continuous improvement quality management believes that zero defect rate can be achieved with zero quality management cost. Then finally, we discussed few key elements of a quality costing system. And the quality costing system should include a transaction processing system to capture data, events, transaction and activities, and then a system of recording and coding, and then a system of summarizing and analyzing and comparing. And then we would prepare a quality cost statement which we would report to the relevant parties. So that's what we discussed in this lecture. Thank you very much for following this lecture, and see you again in the next lecture.